So with that said, let me introduce Ivy Zelman and bring Ivy up from backstage. Marilena, if you can promote Ivy up into the data. Ivy has been both a guide to me, a great consult to me, and a friend of mine for 20 plus years in this business. For those of you who don't know Ivy, she runs a Zelman Associates, which is a Walker and Dunlop company, over 30 years of experience on Wall Street. She's one of the most followed analysts by hedge funds, private equity groups, large home builders, anybody that's in the real estate space. Ivy has made an unbelievable career and is, you know, I have CNBC on behind me all day long when I'm in my office working. And more often than not, I see Ivy's smiling face being interviewed where people are looking to try to understand what's happening in housing. So Ivy, welcome on board to the Weekly Roadmap. I can't thank you enough for being here. And I'm going to take the deck down for a moment here so that people can see you a little better. There we go. And welcome. Thank you for joining us.
Thanks for having me.
We're excited to have you. And so without further ado, I guess I'd like to get a little bit into your perspective. By the way, I love your print behind you of Wall Street. That's a great print. People can't see it, but up above me, I have a Leroy Neiman of the New York Stock Exchange. And so I love those kinds of prints. So if that ever becomes missing out of your house, I didn't take it. So I just want to go on record on that basis. So
Thank you. I love it too.
yeah. So let me just start by opening. Look, as one of the most relevant analysts and thinkers about what's going on in the housing market, you know, we've had a lot going on over the last 4 years, right? We had in the mortgage space, we had two of the biggest record years ever in 20 and 21, followed immediately by three of the most difficult years in my 42 years in the mortgage business, right? It continues to be very constrained. We've seen over 100,000 originators, individual originators leave the industry as we look at licensing and the NMLS system. I'm sure our audience would love to kind of get your perspective in general of what you expect in the housing industry in 2025 and any other insights that you would like to share with our audience.
Great. Well, thanks again, Brian, for having me, and appreciate the opportunity to chat about our outlook for 25. You know, there's a lot of moving parts, but I would say prior to the backup in rates that we saw and the expectation that rates were, prior to Trump getting elected, rates were, you know, headed lower. There was more optimism that we'd have a nice rebound in existing home sales in 2025. We had been looking for up 11%, albeit that's still well below trend line when you look at absolutes or historical turnover as a percent of households. But
Would
still,
that have been on a unit basis, up 11%?
Yeah, a unit basis. But
Yeah.
we were also expecting at that point a benefit from it. You mentioned in your opening comments that inventories were, you know, increasing, which we need inventory. So on a national basis, inventories were up 20-25%. NAR just came out on yesterday and said inventories are now up 18%. So we may have seen a peak in inventories rising as sellers are rethinking whether they want to now sell and lose their low rate given where rates are now today. So given the backup in rates, higher for longer, the risk of inflation from the administration, I'm more in your camp that rates could go higher, but we really don't forecast rates. We use the forward yield curve. And the forward yield curve right now went from 2026, I think, was showing 5.8. Now it's at 6.4. So taking into consideration just sort of the backdrop with higher for longer, we're now taking down our expectations for volumes to rebound more like in the mid-single digits. So still growing, but not accelerating. I think that what we've been characterizing the market as a slow grinding, trying to grind higher. And I think it's really about today affordability, and everyone knows that, or lack of it, I should say, and stretched affordability. You know, we are seeing really the haves and the have-nots, so a real divergence with respect to the market where the entry level is challenged. The builder community has done a great job, in my opinion, over the last 2 years of utilizing mortgage rate buydowns. Really started in earnest in 22 at when rates first started moving higher. I was pretty shocked that, you know, October of 23, when mortgage rates were 8%, they were still selling homes, albeit they were selling them not at 8%. They were selling them mortgage rate down, you know, buying down in the fives. But nevertheless, people were still buying, and there was value that they were looking for. And so I think that will be the likely scenario is we'll see activity for the new construction market benefit from what might be a stalled out existing home sale inventory lift and continue to drive absorptions through incentivizing predominantly mortgage rate buydowns. So I don't think the market will decline. I think we'll see for the builders more like a low single digit for starts, but like 5% for new home sales we're looking for 25. Talking too much, but pricing, we're looking for builders to probably have flat to down pricing, which is inclusive of incentives. On the existing home side, you mentioned that you still expect home prices to rise. We do as well. And basically your point was because inventories remain very tight, and you also have still a very strong economy as a backdrop. You know, I was looking at markets, the top MSAs. We really look at the top 50 MSAs, and the divergence in price is pretty spectacular. You know, you take a market, I live in Cleveland, Ohio, got snow right now, fun stuff, versus your beautiful Newport Beach. But
I saw Kim escape. She's out here in Newport with me, your assistant.
right. And, you know, but I would just say that when you look at a Cleveland market as an MSA, home prices year to date are up 8% because there's no inventory here, and public builders or the general production builder market doesn't really exist here for the most part. So where there are production builder strong presences, there's more of a pressure on price, because as long as there's that competitive of volume available, you're going to see more pricing pressure like we're seeing in Texas MSAs and in Florida MSAs, where there's a lot of new construction. So I mentioned really a tale of two markets. You've got the higher end still performing fairly well. And I think that they're not dependent on rates. There's a lot of cash buyers out there. And I think that there's a tremendous wealth effect that is benefiting, you know, let's say not only the move up market, but also those that are the beneficiaries of having family that are providing them, whether down payments or buying homes for them. But then you have the, you know, let's say on the income spectrum where there's tremendous pressure on the wallet from inflationary pressures, groceries, healthcare, utilities, insurance, all of the factors that are eating into the wallet and therefore making it very difficult to save for down payment. Renters, right now, it's been really challenging for renters because rent inflation's been tremendous, and we're seeing a little bit of pressure now on rent. So I guess I'd say it's not going to be a great year for housing, but there's risk to the downside more so than I think to the upside if rates remain elevated. But I would still characterize it as a slow grind.
Yeah, look, the word slow grind, I think, would resonate with everybody on this call that lives in the mortgage space. That's been the definition of their life for the last 3 years, is slow grind, right? In the process. You know, one thing, Ivy, you mentioned a little bit on the rental, you know, inventory, that kind of stuff. You know, I've got some private equity clients that I work with on a variety of projects that are heavily involved in the rental space, right? Acquiring homes and then renting them out. And some of them have done some of the big deals that are announced with some of the public builders. And I know
Right.
we want to stay away from individual builder names, but what's your general perspective, if you could, on the impact of those private equity groups buying homes in the market, putting them out for rent, right? Because I know it's been great for some of the builders if they have excess inventory or a particular community or whatever, there's a great opportunity for them. But what's your general sense? There's a lot of, and I think my own sense is it varies by market, but what the impact is of the big Wall Street firms buying homes across the country and the impact to price support, and supply.
Well, I think that I would characterize the private equity institutional segment of the SFR market and inclusive of BFR as pretty small. But I do think there's a substantial amount of mom and pop investors too
Yeah.
that are buying and arguably keeping the market very tight. Now, with that said, there is risk right now. The administration, President-elect Trump, is looking at, hard to believe because given the conservative Republicans would unlikely want to take away anything that would be pro-business, but there is a risk that they would take away tax benefits for investors in SFR. And I think that could result in a boost to inventory because if you don't get those tax benefits, many of those mom and pop portfolios, and they're also dealing with higher cost of capital and all their insurance costs, you name it, are going the wrong way anyway. So we're seeing a lot of portfolio sales right now that are happening, not just mom and pop, but larger
Right.
entities as well. But no question, it keeps prices elevated in certain markets, like, the Smile States. It's much more prevalent. If you go into markets like Phoenix or Atlanta, you might be, for the institutional investors, in the double digits as a percent of those markets. But then if you add mom and pop to that, you could be looking at a third or even higher. And had a conversation with a single family rental operator, and they are pruning their portfolio. They listed 3,000 homes on MLS, and two-thirds of those were bought by investors. There was
Really?
definitely an opportunity for primary buyers to buy it, just as the investors could, but they swoop in and they buy those assets, and in trying to, take advantage of what's available on MLS, which is very, as you know, very tight. So I think it is a problem for primary buyers. On the other hand, a lot of the stock is pretty dated that's coming on market, for sale, and needs a lot of refurbishment. So many of the first-time buyers probably couldn't afford to go and do a lot of the home improvements. So we do have I think, a good opportunity for those investors that are doing flips, fix and flip. I like that market, because if you got homes, it doesn't matter if they're 10 years dated or 50 years dated, someone needs to get them, move-in ready, to create an opportunity for those primary buyers to step in. And I think that's a good facilitator in the market to have. But when they're, acquiring and providing rental properties in lieu of ownership, I think there's no question it does have an impact.
Yeah, I'm not going to ask you to opine on this. Just for those that are listening that are originators, Ivy just mentioned fix and flip operators, and there's a lot of them floating around in the country. Using a combination of DSCR, non-QM loans, if you can identify fix and flip operators that are looking to sell, the opportunity, to Ivy's point, of mom and pop investors coming in and buying. I know we had Joe Massey on as a guest speaker, who works for Castle and Cook in Denver, a couple of weeks ago, and he does a class for realtors where he helps realtors understand how to take an investor client that they have and build a 10 property portfolio for that investor client, right? Not 1,000, not 100, but just 10 homes in Denver. You want to be an investor, you want to own some property, and you want to take advantage of leverage growth and home appreciation. Those kind of opportunities, if you're not savvy with that kind of product, it's a great opportunity. I see originators doing this all over the country. And I think I think people thought that when price appreciation went up, that fix and flip went away. It hasn't, by any stretch of the imagination.
Right.
Ivy, one of the comments that I wanted you to maybe share some of your views. Demographics obviously are changing across the country, right? And when I talk to some home builders that I have as clients for a variety of things, I just helped a couple of home builders acquire mortgage operations over the last couple of months. And when I look at those home builders, and both are privately held, they're very focused on the first-time home buyer, first-time move-up segment in terms of inventory of what they're building to, because they see immense demand, to your point, in the marketplace. But what role do you think, we hear a lot about the millennials, Gen Zs, the change in buyer, what they look for. You spend any time talking to builders about that type of, is the buyer different? Is their expectations different? Is product being built differently, or demand curves in those segments? How do you see that impacting, particularly the new home market?
Well, the builders are being forced, as they always have been, to go further out, for those to have to drive to qualify, as we talk about that. And I think they're building smaller homes. In 2015, the average square foot for the builders was about 2,700 square feet. Now it's down around 2,100. So they've been providing smaller homes to create more affordability, and they're also going further out. And that's allowing, whether it's Gen Z or millennials, to purchase and keep them in the market. But I think there's more dual income households, which is, helping to offset it. If you look at the average payment, median payment as a percent of gross income, add homeowners insurance, add property taxes to a single income, not dual, you're looking at 59% on average of their income goes to buying the median existing home, which is absurd.
Sure.
And not likely possible. So when you look at the number of
By
people,
the way, it's 59% of gross income.
right, gross income.
Right.
And that's on average. But when you look at the number of people that are therefore having dual income, and or even multi-generational living, I think that's a product that the builders have been offering more, whether it's the in-law suites, or, you've got the sandwich, the Gen Z's got the boomers and they've got the Gen Z or the millennials living with them. So there's a more consolidation, I would say. I mean, my daughter, the oldest, is 24 years old. Fortunately, her mother can help support her. But those that are, young adults today, and she's a millennial, she's like, Mom, my friends can't afford to buy a house and they barely can afford to live on their own. They're all living together, a lot of roommates, coupling. So I think that trend is where the builders, where they can provide that multi-gen product, I think they're doing so. But as I said, whether it's the demographics, the backdrop is really not favorable for young people today. My youngest daughter said, you know what, you guys handed us a bag of rocks, Mom. Us being the Xers, it's our fault. But when you look at one thing with the mortgage, I wanted to highlight, and I put it in the deck for everyone to look at, that concerns me, is that mortgage originators have been increasing their originations for over a 50% debt to income back end ratio. And
Yes.
in 2020, we were at 7% of originations had back end ratios above 50. And at the end of the second quarter of 24, we were at 12%. And that also, the 43 to 50 has also been growing. And now we're seeing delinquencies rising faster on 30-day delinquencies and also at higher delinquent rates. And I think that is a concern that, to get people in a home, they're pushing the envelope, they're stretching, because FHA and Ginnie may allow it. And I think Fannie and Freddie have also some offerings that they allow it. So that's a concern about, are we putting people in houses that arguably don't have the wherewithal if their car breaks down or their roof is leaking and something were to happen to them? And I think that's a small segment, but something that we should be watching and be more prudent about. Or even chatting with, I think it was, won't mention the lender, they're coming with 100% LTV product again and trying to get more people in the homes that way. Exactly. So there's a little bit of gamemanship that needs to be recontemplated, I think, to mitigate risk.
Yeah, look, I see it. I have clients that are non-QM lenders that are branching out, going into home equity and other areas as the reason I'm involved in helping them build those strategies. But the advent of non-QM lending, I think, is driving some of that as well. And look, as an originator who's on pure commission, I get, the customer shows up, they have a desire to buy the house, they've signed a contract, and you're trying to serve the need.
Right.
I would just echo Ivy's comments that, and all of you on the call know that I'm an ex-Countrywide guy, right? And I ran the prime mortgage division of Countrywide. But I can just tell you, when you get up every day and somebody yells the word predatory lender at you, it's not a great day. And just secondly, I've just never really seen a foreclosure create a lot of really great referral clients back to you in the process as well, because everybody forgets you fought hard with the consumer to get them into that loan and get them into the house. All that's forgotten the day somebody shows up to take the house away, right? In the process. And now you're the villain. You were the hero in the beginning. Now you're the villain. So just be really thoughtful. And look, I think there's a lot of issues around this topic in fair lending and a variety of other things that you have to be really sensitive to as a lender and be thoughtful about it. If you're a long-term player in the mortgage business, your reputation is a great old saying that it takes one bad decision to ruin a life's reputation, and be very careful on that point.
And also, I think
Go
that
ahead.
on the flip side, what we're seeing, it's interesting. If you look at the burden of shelter on both renters and homeowners, that they're spending, originators don't really want you to spend more than 30% of your income on shelter if you're a purchaser. And when you look at the percentage of people today that are homeowners that are spending more than 30% on their mortgage payment, it's only 23%. And compare a renter, how much a renter is paying more than 30% of their income, it's like 60%. So when we look at what today's homeowners that are no longer or in a home and they're not the prospective buyer are in great shape. They have tremendous equity. And I think that they could tap into that equity, whether that's, be convinced, and realtors like to say there's the 3 Ds of real estate: death, divorce, default. They'll always be, even in a recession, transactions. What you need is the D of discretionary, and that happens in a good economy. But if you're locked in with rates well below prevailing, that makes you disincentivized. But I do think we're so rich with so much equity, and the homeowner today is in such great shape that they will, whether they want to move to they're empty nesters and they want to go to a, warmer climate, or they want to be near their grandkids, and people are going to move. And those are the clients that you should be focused on, because they're rich with equity, and it's not just about what rate. And it's just a question of, hopefully you have a Rolodex of clients you've been working with for a long time, and those needs will arise. But I think that's where the haves and the haves not, and the inequality gap,
Yeah,
just one more interesting stat. We did this very large affordability report that I can reference and send it to you, and you can share it with everyone.
that'd be
But
great. Thank
one of
you.
the things we looked at is, how do we, break this inequality gap? What do we do to narrow this gap? And really, what part of it also is the homeowners have so much, wealth created, but then the homeowners, what percent of homeowners actually invest in the stock market versus renters, and how much? On average, 9% of renters actually are invested in the stock market, compared to 50% of homeowners. And when you look at the absolute numbers, the homeowners are investing 75,000 on average, and the renters are investing less than 10,000. So it's that lack of
It just exacerbates the gap
exactly
dramatically. The market's been up, house appreciated. Look, if you're sitting on a 2 point, the last mortgage I had was at 2.875. If you're sitting at a 2.875 mortgage and you're a homeowner and you've had price appreciation for the last 5 years, you are fat with equity, and your house balance sheet looks fabulous. If you
right.
have 401k in the stock market and you're investing separately, you are doing really fine. If you're not in that profile, it feels like the economy is running away from you a little bit. Just there's a question. Brian C. in our chat has a question that I think you can maybe speak to, Ivy, which is, maybe I'm missing something, but how is the economy considered good if a single income on average takes 59% of gross income for a PITI payment? Clearly, there's a portability issue, and I think it's a little bit of what you were just touching on, right? That you have this bifurcation of the economy. People have money to spend, and they're spending it, maybe more so than the Fed was hoping, right? At some level, they're out there in the marketplace. Just speak to that a little bit as to
Well, I think you're right. I mean, there's a
well, we've
bifurcation.
had these challenges,
I started out with saying the haves and the have-nots, and
right?
what we're seeing is that the inflationary pressures, while albeit have moderated, they're still seeing increases. So we're still seeing, whether it be non-discretionary type of expenses that are eating into what would be otherwise available for discretionary, it's all going to call it the non-discretionary, and those people are in a very bad position, and they're hurting. And you see it in delinquencies for auto loans, you see it in mortgage delinquencies, you're seeing it in credit card delinquencies. So I think there are people out there that are not in the camp that it's a good economy. But when you look at the job growth and you look at what's happening sort of on the higher end of the spectrum, everybody's feeling pretty good. So I do think that it's a little unfair to characterize the economy as great when you have people that are probably barely making ends meet. But there is no question that that's not only prevalent, but I don't see how it goes away anytime soon. I mean, I don't see incomes rising fast
There's
enough.
no immediate fix.
Yeah, there isn't an immediate fix. So to Brian's point, I think it was Brian, you said, I think
Brian C. Yeah,
absolutely a bifurcated market.
yeah. Um, Another question that we have in that maybe you have some perspective on as well. There's this emerging issue. Look, I live in California. I've been with State Farm for, I think, 43 years, unabated, right? On every piece of real estate I've ever owned, my cars, my boats, whatever, right? And State Farm is now sending these little love letters telling me, hey, we're not so sure we're going to stay in California for more than a year. Maybe you should be out shopping, right? Which I'm doing, by the way, as a side note. How much do you see, or do you get a sense, this rising homeowners insurance inflation in the Floridas, the Californias, but I don't think it's just there. It's kind of
No, it's everywhere. And I think, there's very few markets where, insurers are not raising premiums to account for the losses that they're experiencing in those smile states, or those markets in the Southeast that are very much at risk from climate, hurricanes, et cetera. And I think the insurance industry is in total turmoil. And I think that there are now state insurers that are picking up where the private insurers are backed out. I mean, State Farm, as well as Farmers, left Florida, and State Farm, I thought, exited portions of California.
they've exited portions. I'm
Yeah,
still in the part because I'm not where there's a lot of fires.
Yeah.
I'm sure they're worried about, earthquakes and everything else, locusts, whatever, but,
Right, right. I
so,
just think that, it's an incremental cost to the homeowner that they are in some cases opting to self-insure, which I think is very dangerous. We're seeing more self-insurers, especially at the higher end. People are calculating the risk and the probability that, they'll have to fix their homes themselves. It will cost me a lot less. I hear that contemplated quite a bit or actually, implemented. And I think that we're going to continue to see premiums rise. And we actually, in that affordability report, we went back and looked at what percent of the income goes to homeowners insurance, and it's more than doubled when you go back a decade. So as a percent of your income, it went from 2 to 4 or something like that. But it's
yeah,
nothing, it's still eating in to your income. And
yeah,
just another reason why, homeowners may be challenged to buy today. Those existing homeowners, as you pointed out, they're equity rich, they feel good about their stock market portfolio. They're going to have to eat it or they'll self-insure, but it's another headwind to the first-time buyer, no
yeah.
question.
It's always, I try to make this point when I do speaking in this, I'm talking to some builders, next week, in fact, that want some perspective on a few things. And the issue I always try to remind people is every dollar that goes to insurance or taxes is a dollar that cannot go to P&I. And if you take 6 or 7 of those dollars, that's $1,000 worth of qualification in terms of a loan amount, right? In terms of a monthly payment. And it all just kind of continues down. And so for every dollar in one direction, you're eating into qualification capability, which you all already talked about.
But it's interesting when you look at the migration that we saw during COVID, which doubled more than what historical migration was in most markets, whether it was the Northeast to the Southeast or it was the North and Midwest to the West Coast and Southwest, wherever people went, they were fleeing those more expensive markets as well as colder markets. And those homeowners now, we're seeing people recontemplating, do I really want to be here? And you look at the Midwest as an attractive, more affordable place to be, not New York, of course, but I do think people are reconsidering living in some of those more climate prone markets that they've been dealing with floods, fires, heat, excessive heat. So if you're originating nationally, do you have a strong presence in the Midwest? Because I think the Midwest could be a bit of a darling if we continue to have, I'm not trying to make a
It's the
claim.
rebirth of Cleveland.
Yeah, right. Well, just thinking about climate change, I don't know, man-made or not man-made, but if we have continued storms, continued problems, and
Right.
people can move elsewhere, my girlfriend lives in Long Island, New York, where I grew up, and she visited, and she's like, holy crap, I can buy like 3 times what I can in New York for what your house is. And so people may start to rethink where they want to live.
I couldn't agree more. I just saw a comment in the chat that nobody ever gets sick of shoveling sunshine. That is
Yeah.
true. But to your point, look, if you're a young family and you have the opportunity to work remote or that kind of thing where it doesn't really matter where you live and you want to be a homeowner and get to participate in home equity over the next 20 years, right? And I listen to the Oracle of Omaha occasionally, right? One of the things he always makes the point, when I buy farmland, I buy real estate, I buy something, and I think, how's this going to look 10 or 20 years in the future? Where else would I put my money, right? In terms
Right.
of the process. And so you want to get on the real estate ownership bandwagon. There are cheaper markets, places where insurance is not going up as fast or has been as impacted. I'm in the process of opening up 2 insurance agencies for home builders,
Well,
primarily to help them mitigate people showing up late in the transaction and not having their insurance binder or the capability to close and creating closing havoc and that kind of stuff, because there are firms out there that can bring 15 or 20 underwriters into the process so that they know that they're set. It's a moneymaker, but it's this much
right.
of a moneymaker. It's
Yeah.
really a facilitator to get the house closed, and that's where the builder
Sure.
at, right, in the process. So as you and I don't we didn't chat about this, so if you don't have a perspective, it's fine. But the realtor commission lawsuit settlements, how are you seeing, or how are you seeing that impact? For instance, are the builders seeing any reduction in the realtor commissions that they're paying? Do you see it as an impact to housing at all?
It's been a bit of a non-event so far.
I agree. I'm just
I
curious
mean,
if I'm missing it.
I think that it's about transparency and disclosure.
Right.
And I think
Which I'm
some,
all for, by the way. I think that's great.
yeah, and I think that, the buyers that are out there that now have to have representation or they have to pay the buyer's commission, um, they can't afford a lot already. So that's just an incremental cost to them. And I think it's going to be challenging for them to buy and have to pay their buyer's agent. So the seller is still really paying the buyer's agent, but they have to upfront know what the story is. And I think that it's just about disclosure. And maybe commissions, might be flat to slightly down, but we have not seen anything material that would be concerning. And I actually think some of the builders, like Meritage, welcomes the realtor community and wants to grow their dependence on the realtor community because they believe that they really have a competitive advantage. And others are pulling away from realtors. So I think that there's more benefit to working with realtors. And I think they're here to stay. And I think the better quality realtors that have really more success or a bigger network are gaining share at the expense of the, people that entered it in the heyday and thought, hey, this is a great way to make a living.
Yeah, look, there's no doubt for folks who have been part of this podcast over the last several months. I make this point occasionally. I have a Goldman Sachs backed prop tech client that I helped them buy a mortgage company last year, and I get a lot of data about just agents in general, and they're primarily focused. Their primary business is focused on the top 1.5% of agents and realtor teams across the country, right? Last year, 2023, we don't have the 24 data yet, but I think it's consolidating even more. The top 1.5% of real estate agents and or teams in the US accounted for 68% of sales.
Wow.
Right. And so you have this consolidation to the top. And I think some agents and we're seeing it, they're seeing it. Some agents, they represent today about 6,000 of the top 1.5% agents as part of their platform. And some agents that are fearful about these commission changes or they're uncomfortable talking about representation or whatever the case may be are now consolidating to those teams, right? They want to, some strength in numbers, strength in other people that are maybe better at it than they are that can help them. And maybe they're very nichey about, listings in this particular group because it's their community, their country club, whatever, right? And they hook to
Well,
a team.
I heard an interesting story from an independent broker that was telling me that, when you buy leads from Zillow and you're a realtor, let's say you don't have a sphere and you're just trying to grow your business, and
Right.
you show up and the consumer that, you basically said, we'll come show you the house. It says, wait a minute, you're not the listing agent? You want to represent me? No way. And then all of a sudden the buyers now, the agent who wanted to represent this buyer kind of bait and switch or tried to. That's now resulting in that person having the inability to take those leads and convert them because you have to provide that disclosure. And so you're actually seeing the seller's agent or the broker that's representing the seller, they're doing better because then they're coming to them and they
Yes.
get more business. So anyway.
That's correct. Yeah. Look, I think those are this kind of subterranean shifts that are going to go on in terms of kind of a reapportionment of where some of those deals get done and how they get done. But to your point, I thought I got interviewed right after this thing got announced. And my view was, look, there was a book written back in the 70s called Lambs for the Slaughter.
Hmm.
It was about real estate selling in America and how much the buyer didn't understand that the realtor was really contractually obligated to work for the seller, right? Because that's
Yes.
where the commission was coming from. So the fiduciary obligation was always to the seller. So when you said, well, tell them we'll pay 300, but we will really pay 350, that the realtor was obligated to tell the seller that, right?
Right.
And
Right.
so this lack of transparency, I think in any business, I think in our business,
Right.
our industry, I don't know if you've been tracking this or not, there was a bunch of legislation that I think is now going away with the new administration about trigger leads.
Mm-hmm.
And one of the things about the mortgage business, we have a nasty habit of finding something that works. It's a good idea at the beginning, and then we abuse the hell out of it. We do it too much. And today, if you are on the phone taking an application with a customer and you pull their credit bureau, that customer probably has 20 phone calls while you're on the phone taking their app from other lenders who got the trigger lead fired out to them, and now they're on the phone trying to take the deal away, right, in the process. So I see lenders delaying the pulling of a credit bureau so that it's not a jump ball until later in the process. And there was legislation underway to kind of kill off trigger leads. And it's just another example. I think disclosure is sunlight, and disclosure is a great anecdote for a lot of bad acts, right, in the business. So Ivy, we're about 5 minutes before the top of the hour, and I've got a couple of the slides in the deck. And for the audience, I'm going to let you guys take a look at it. We've got our normal, personal development slides in the deck. Ivy's slides are in the deck. She was gracious enough to share some of her work and thoughts in the slides in the deck as well. With about 5 minutes left, do you have any other, if I don't think you've ever been in the mortgage business, but you've been around it an awful lot and you track it an awful lot. We've talked through the years. If you were sitting in the mortgage business today, what advice would you give folks that are maybe on the audience about how to think about 2025, and feel free to go to 2026, but how would you think about the market? Any advice you have for anybody, and or thoughts in terms of closing thoughts?
Well, assuming, the volume is the name of the game, right? You need scale.
Right.
And the builder community is where the volume's coming from, albeit even if it's underpriced or under pressure, having to build that relationship with builders and making sure you have a good builder customer base, I think would be a focus of mine if I was an originator. And clearly, whether it somehow going after that higher end consumer, and whether it's working with relocation companies and trying to get to those equity rich clients, that would be where I'd focus and try to penetrate, just where the benefit of volume will come from.
Right. What do you see as the potential rocks that the boat could run into here in 25? Is there things you worry about the housing market that are like big,
Yeah.
sometimes in life it's all about avoiding the big rocks, right? Maybe you'll hit a small one, but don't
Well,
sink the boat.
I think unfortunately, it's more not, it's going to impact the market, therefore impact originators. If we start to see the impact from the tariffs that are being contemplated, from an input cost to builders to, all aspects of
Lumber being a huge thing that comes from Canada, right? Very heavily.
That coupled with the deportation risk, which right now a lot of people are very complacent about it. They don't really expect it to be any other than those that are already in jail, or they're criminals that are already received deportation papers. So I think those two things are pretty significant headwinds and could result in pretty substantial inflation. If we pull out a lot of workers that today are in construction or in agriculture, and food prices will go up. And, we've got so many I'd call it pending headwinds to the industry, that it's more concerning to the downside than the upside. I don't see anything other than rates heading lower, but not for good reasons. If rates go down, it's likely that we're hitting a recession.
Right.
So
Or there's a war, or there's something, right?
think something out there that's not good. And I think that, we look at some of the administration's proposals besides tariffs and deportation. I mean, I don't think it's going to happen. I don't think GSE reform will happen. We had a call with a policy expert that the administration is talking about going back and trying to remove them they're already reformed out of conservatorship. If they do that, why fix it? It's not broken. And certainly it could create havoc in the market. I mentioned the SFR. I'm just thinking of the federal land that they want to propose to sell to developers. I think those parcels are so far out. Even the cows don't want to live there, I joke.
Exactly. Right.
So
There's more bears than people.
yeah, I just see that there's more challenges than maybe the market's even dealing with today that can present themselves. So be lean and mean, and be ready, be on guard. And I think today, keep your leverage low. The cost of capital is probably going to maintain at a higher level. So it's tough. I think it will just wean out the weaker players, frankly.
Yeah, look, I think that's dead on. I think there will be continued. First of all, I have 3 M&A deals I'm in the middle of. I just closed 3 M&A deals in the last 75 days within the mortgage business. Some of them are not announced because it's private to private, and asset deals, those kinds of things that are happening out there. Originators have left. And one of my messages to our audience has been, look, if you've survived the last 3 years, here's the good news. You have a lot less competition at the street level, right? Tragically, because a lot of people have gone out of the business and
Right.
will continue to consolidate their way out of the process. And then second to that, one of the things I try to share with people in our business on the sales side is, I get asked all the time, what do you think, what do you think the Fed's going to do? What do you think rates are going to do? First of all, I have no freaking idea. Let me just say that. And I'm not so sure anybody else does either, but I'm sure there's a lot of smart people that probably do have a sense of it. I think the new proposed Treasury pick was a good pick for the market, right? Because he's a pretty balanced guy, knows the markets, understands the impacts of decisions, those kinds of things. positive. We saw a little rally right after he got announced in rates. But my message to the sales community in the mortgage business is don't keep looking at the 10-year, don't keep looking at mortgage rates. Go build the top of your funnel and focus on tactics that help you convert leads that you get. You want to make more money, convert more leads that you're already getting, and think about broadening your marketing efforts in social media and your community. And I have a great suggestion, builders. We have some people, because I see the attendees, that I know in the Southeast have an immense business built being the second lender on huge builders that have an internal mortgage company. And I think a lot of people think, well, they, Lennar or somebody, right? They've got an internal mortgage company. I can't do any business. Not true. Not
Right.
true.
They'll
Not even close to
outsource.
true.
Right. I mean, they have a capture rates anywhere from, 50 to 80%. So what they're not capturing, they're basically farming out for whatever reason.
Right.
Many cases, they don't want to do that loan, or they've got too much exposure. So I think that you should not give up on those large builders.
Yeah, I couldn't agree more. So anyway, so my message is, folks, I wouldn't live and die off Chairman Powell's comments over the next couple of months are going to be what they're going to be. Focus on building your business, focus on being a better, more professional mortgage originator. Focus on your past customers. Think about other ways to originate volume out of your existing or current customer base. And there will be a better day. There will be a day where I think rates will begin to come down. We're just not there, right? And so I'm just looking, anything else in the chat session, Maria Elena, in terms of questions that I may have missed or hand raisings?
I do see one. Ivy, thank you so much for doing this. You're getting thank yous and applauses and stuff like that. So thank you. Do you see the return of new construction condos or condo conversions on the horizon? Is the only other question here in the chat.
Condo conversions from rental product? Is that what you're asking?
Just condo, yeah.
Yeah.
Rental to condo, right? Just coming back as
I would say it's negligible. It's not really anything that would be material. There are some in markets like New York where you see a lot of product that, rental, there's too much product, but not enough to really move the needle.
And who doesn't love to lend in the state of New York? Right?
Right.
I was just on with an M&A target yesterday that actually does a fair amount of lending in New York, and their view to the buyer side was, yeah, it's significant, but here's what we should do. We should just drop our New York license to get the deal done, right? It's a roadblock. And so that's, and as a born and raised New Yorker, I get it. Yeah, that's why.
As I am too.
I know, I share that with you.
Right.
So, well, look, Ivy, I don't see any other questions. First of all, I just want to thank you personally for doing this with us. It's
Anytime.
happy to have you on board. I thank everybody for joining us today. Absent any additional questions, I see a lot of claps and thank yous showing up in this process. So I'm going to let you run. I know maybe you got to get out and shovel some snow, I'm sure. And
I don't think so.
By the way, what the hell are you doing in Cleveland in December? I would think you'd be in the Florida property in December.
Let's just say I'm headed to Fiji with my family next week.
Okay, there you go. Perfect.
Yes, but Merry Christmas, Happy Holidays to everyone, and appreciate the opportunity.
Same to your entire team. Thank Kim and everybody for all their help in putting this together.
Right.
And we'll talk to you soon.
Safe flight. Get to Texas.
Thank you. All right.
Thank you, Ivy.
Bye.
Bye-bye, everybody.
Thank you.